Hello and welcome back to another episode of What's Not Priced In. This is the second episode of the new season of 2024. Obviously, Greg Canavan is not here with us today, but he will be back next week. But we've got someone who's an expert of experts. He's our resident commodities expert, and he is James Cooper, a trained geologist, and now he is the Fat Tails commodities expert who also runs the Diggers and Drillers Investment Advisory. Now, James, welcome to the show, and hello and welcome, and just maybe you can introduce yourself to the viewers.
Thanks, Kiryll. It's great to be here. It's been a long time. I think we haven't done one of these sessions for I think it was about midway through last year. So it's great to be back. Looking forward to sort of being a regular guest, maybe coming on every few months and just giving listeners a bit of an update on commodities and the markets. Looking forward to it.
And maybe what's your background? So when people say you're a geologist, what does that really mean?
Okay, so a geologist, basically, I think most people would understand that a geologist is focused on understanding the rocks. So when we look at mining, what is the main asset that company holds? It really is the geology, it's the rocks. So what I try to bring is an understanding of the geology for the mining and exploration companies that my readers look at. But we also look at the sort of broader macro picture and try to bring that into our sort of stock selection. Because that plays a really important role in commodities, whether it's the supply or the demand, geopolitics. So a lot of different factors come into our stock selection, and that's what we try to sort of convey with our listeners and our readers.
Yeah, I think definitely knowing the rocks in depth is a huge asset in commodities investing, because I think a lot of investors aren't actually as equipped to understand the actual geology of the assets, and if you do, it really is a huge help. But I have a huge amount of stuff that I want to discuss with you today. Obviously, commodities in general, how commodities performed last year, maybe your outlook for commodities in 2024, and then I want to maybe get your thoughts on certain commodities that have obviously been popular with investors recently, and now obviously lithium last year, a few years ago, and currently obviously uranium. But maybe I was going to ask you about just briefly what your thoughts were on how commodities performed in 2023 and what you thought was maybe the biggest driver of commodity prices last year.
Okay, so commodities, if we look broadly, it was a pretty poor year, especially for the junior mining stocks. And as with commodities, we can't really broadly state that all commodities are up, all commodities are down. There's always outliers. Of course, we saw uranium, as you mentioned, which has really picked up, and it's still really going strong into the new year. Of course, we saw on the sort of other spectrum was lithium, which had an absolutely bloodbath in 2023. And that followed its major peak, which occurred in November 2022, so the very peak of the lithium boom. But then we look at sort of the more other commodities, sort of sitting on the edge, not really booming, not really falling away in 2023, and things like copper, gold, silver, all these commodities sitting around what I'd say still sort of fairly elevated levels in terms of prices. Historical prices are still well above their cyclical lows from 2016. So I think moving forward, that puts them in a good position if we see some technical strength, maybe especially for gold breaking past its all-time highs. So we're still sort of in that limbo area and waiting for gold to make its much anticipated breakout. And I think when that happens, that will really sort of set the stage for for some of the more mainstream base metals like copper and aluminium to really follow suit as we sort of move into this upswing in the commodity cycle.
Yep. Well, yeah, speaking of the commodities outlook for the future, you recently wrote that 2024 could be a crucial year for commodities, and then you said, I quote, US election, China's stimulus, rate cuts, weakening US dollar, the rise of emerging market economies like India. Any one of these events could ignite the sector in 2024. And I continue the quote. In fact, I believe the hazards holding back mining stocks reached a final culmination in October 2023, a major low in the market. Now, obviously, briefly, my question too is, why do you think 2024 could be, maybe elaborate on why 2024 could be a crucial year, in your opinion?
Yeah, absolutely. So I think a few things there. So I think if we looked at the US elections and why that could potentially be a bullish outcome for commodities in 2024. So one of the key reasons. So we've looked at the US, India, and a number of countries. I don't think that the economists reported that 2024 is set to be the biggest political year in history. And we think about what incumbent governments typically try to do leading to an election. That's usually involves big infrastructure plans, announcements. So that's quite bullish for some of the more industrial metals like iron ore or aluminium or copper. Then we have the big elephant in the room, which is China, and there's still this big fixation on the property market in China and weakness there, but manufacturing is still strong. The industrial is still strong. So I think the latest figures point China growth at about 5.2% for 2023. So it's still not meeting the big growth that we saw from in the early 2000s. But given the GDP is much larger, I think that's still a solid growth outcome for China. So that bodes well for iron ore and copper. And I think there's still the possibility of a strong stimulus announcement from China, especially to prop up that property sector. For the moment, the Chinese Communist government has really just been announcing tidbits of stimulus, which haven't really moved the market. But if we did see a bit of a scare in its property market, that could actually bring a positive outcome in terms of a much larger stimulus announcement.
Yep. And I think you've briefly mentioned iron ore, and iron ore is quite popular on What's Not Priced In. Both Greg and frequent guest Callum Newman have spoken about iron ore quite a bit. I think Callum is more positive on iron ore than Greg. Obviously, in recent days, iron ore stocks have sort of sold off a little bit, and the iron ore price has come down a little bit as well. What's your outlook for iron ore in 2024 and beyond? Are you sort of optimistic? Are you cautious, pessimistic?
Yeah, I know a lot of analysts are predicting a top for iron ore, and that makes sense. Just looking at the slower than expected growth in China, especially in the property sector, it's difficult to see where that potential growth is going to come from. And of course, if we want higher prices, we need growth from somewhere. In terms of a price collapse, I just don't see that coming. While China growth is still quite robust, bringing around sort of above 5%, and what we spoke about with industrial. I guess another elephant in the room for iron ore is growth from India and the Southeast Asian markets. I think Rio Tinto recently flagged it sees strong exports going to those markets, and that will drive growth for iron ore demand in the years ahead. So as long as China stays steady and we see growth from India and Southeast Asia, I think that bodes quite well for iron ore, which would probably go against the mainstream tide, which is calling for an imminent iron ore collapse. So I just don't see that happening.
Yeah. Well, that's a nice quote there. You're not buying the hysteria there about iron ore. Well, you mentioned a price collapse. I have to talk to you about the price collapse in lithium. I think that's been a big story in the small caps and mid cap sector for a few years now. And maybe I'll maybe set the scene. I think a few years ago, and I think in November 2022, you wrote a piece for Fatel Daily, and you described lithium as a, quote, a one-hit wonder. And I think that proved quite prescient, because you sort of you called it a one-hit wonder because obviously it's principally used in the manufacture of EV batteries, and simply, obviously the case for lithium for years now has been, it rested on the optimism of the uptake of EVs, and recently the uptake of EVs is still strong, but not as strong as many have expected. And I think just last week it was reported that the share of electric vehicles sold in the UK actually stalled for the very first time in 2023. So EVs accounted for about 16.5% of all new vehicles sold in the UK last year, but the year before that it was 16.6%. So market share isn't actually growing anymore, it's stalled. And I think the Financial Times reported that EV demand across the globe is sort of not growing as fast as many expected. And I think it sort of quoted some automakers that said there's a, quote, slowing appetite for EVs. And an interesting point was that I think now the market is sort of shifting from early adopters of EVs to more, money conscious mass market consumers that really care about the price, not necessarily whether a vehicle is electric or ICE. And I know I'm rambling on, but I'm just sort of setting this scene so that I can ask you some more questions about it. So the 10 worst performing stocks of last year, of 2023, on the All Odds included 3 lithium stocks. So Lake Resources, Core Lithium, and Sayona Mining. I think Lake Resources just hit another 52-week low this week. But the interesting one is Core Lithium. It's not exactly a specky developer or a junior. It became a newly minted producer. But the realities of being a producer have hit Core quite hard. So I think in January, it obviously famously or infamously announced to the market that it will suspend mining operations at the Finniss lithium mine and just sort of continue stockpiling. And it said it would only recommence mining when market conditions improve. Obviously, the question is, when will that happen? I think it also announced some job cuts as well. Well, I'm really rambling on here, but I've got some more.
Yeah.
So, and I think the question, I'll have lots of questions for you, but I think I wanted to mention as well that in late December of last year, analysts at Citi released a research note sort of assessing all of the Aussie miners, lithium miners, along the cost curve, and it found that Core's project wasn't actually the only one that isn't economical at current prices. So I think lithium spodumene prices fell maybe over 80% in 2023 and have continued falling early this year. And other projects in Australia are currently uneconomical. So my question to you is this the bottom for lithium? Is there, are lithium stocks a contrarian buy right now, or do they present a value trap? Sort of how do you assess the lithium sector right now, and what are your thoughts on it? I'll stop talking now.
No problem. Yeah, so it is such a big question, I think, at the moment. Lithium, so where does it go? I tend to think, so not just lithium, but the future-facing metals, so lithium, graphite, rare earths, you could throw cobalt, nickel in there as well. What really hit them in 2023 was this rising cost of capital, so projects becoming much more expensive to develop, but also just the appetite for renewables and green technologies has really, and the demand for EVs has really shifted with the rising interest rates. So I think because we are going into sort of a more deflationary period into 2024, so potentially lower interest rates. That could bode well for these future-facing metals, including lithium. So that's certainly something to keep on the radar if you're looking at getting into these stocks at much lower prices.
Yep.
In terms of, thanks for pointing out 2022, and so luckily I did steer readers clear of that major top in November of 2022. Unfortunately, we did step into the lithium market by about midway through last year, thinking that perhaps we were near a bottom. Of course, the sell-off continued hard all the way through to the end of the year, and it's still really underway.
Yep.
So it is difficult picking a bottom in this market. It is a case of trying to catch that falling knife. So I think interest rates really do remain key, just in terms of sentiment going back to these sort of renewables and these expensive mega projects that will require a lot of capital. So that the appetite has to come back. And I think because of all this, I think people have started to look at the brown commodities, so traditional forms of energy, which are energy dense and much cheaper. So that's caused some price surges among those commodities in 2023. So whether we see a shift between the green or from the brown back to the green in 2024, I think is going to be a really key element of where this market could go over the coming years.
Yep. And yes, maybe continue on with lithium. Were you surprised at just how at the extent of the price collapse in the lithium market? I think, as I said earlier, lithium spodumene prices fell, precipitously, like 80% in 2023, and I think maybe some investors or viewers are probably thinking, how is that possible? What was the driving factor? Was it just that so much supply came online at the same time that no matter how much demand was there, that supply just sort of swamped the market? Was that basically what happened?
Yeah, definitely supply, and I think it happened quite early in the year, 2023. So we actually saw a big bottom in spodumene and lithium carbonate prices in early 2023. And at that point, the producers and the explorers were pretty resilient. So the equity prices were holding up really well, despite the spot price really falling down. So as we moved further into the year, the spot price did recover. And that sort of helped a lot of the producers and developers stay buoyant. Of course, they were coming off their peaks from 2022, but the market has sort of, I guess, priced these equities more in line with the underlying spot price. Some would argue that producers still trade at a premium to the spot price, which is probably one of the key reasons why we could see a bit more selling pressure earlier in this year. So until we see sort of a more harmonious matchup between the equities and the underlying price for lithium, we probably won't see the major low for the sector. But when that happens, I think a recovery could certainly happen quickly, and that's probably when investors should sort of look at getting into that sector.
Yep. I think the next topic that I wanted to discuss, you've actually already sort of alluded to, which was that obviously lithium wasn't the only sector that floundered in 2023. Like you said, other green energy transition metals didn't fare well either. So I think currently the 10 most shorted stocks on the ASX feature quite a lot of the green energy transition stocks. So Pilbara Minerals is the most shorted stock at the moment with 21% short interest. Graphite producer Cyro Resources is second with 15% short interest. Core Lithium is third with 13%. Sayona Mining is fourth with 10%. And then rounding out the top 10 is Liontown Resources. That's currently sitting at ninth with 8.4% short interest. And obviously today we're recording this on Thursday afternoon. Today was news that giant Albemarle sold its stake in Liontown Resources, and that sort of sent Liontown Resource shares lower, much lower today. But clearly 2023 and the start to 2024 hasn't been a great year for green energy transition stocks after so much enthusiasm and optimism, and I guess you could say hype in 2022 and maybe 2021 about renewables, green energy and transition. We need more nickel, we need more copper, we need more lithium, we need more cobalt. All those things could be true, but as an investor, that thesis hasn't really worked out in 2023. And I think recently you wrote that, quote, last year was a bloodbath for mining stocks tied to the green energy transition. But with markets rallying in the early part of 2024, green miners continue to lag. Unfortunately, that doesn't bode well for a sharp turnaround in 2024. So, yeah, maybe I just wanted to get more deeper thoughts from you on exactly what happened and why has that green thesis not really worked out. And obviously, you've mentioned interest rates played a big role in that.
Yeah, and I think they still will.
Yeah.
And we look at the Federal Reserve in the US and even track that with what's happening in the lithium market.
Mm-hmm.
So late last year, we saw a bit of a recovery of sorts in some of the big producers for lithium miners like Alchem and Pilbara Minerals. So these stocks recovered sort of 10-15% quite quickly. As the Federal Reserve announced these more dovish approaches for 2024. Then we've seen the Federal Reserve sort of reverse on that rhetoric and turn a lot more hawkish. And now we're seeing this another leg in the sharp sell down in lithium stocks. So I really believe that the interest rates are going to play a critical role in the outlook for graphite lithium in 2024, and I don't see any change to that. So if we see interest rate cuts happen at some point, I think that could really bring this story back to the forefront, from the brown commodities back to the green. So I think that's the key feature that investors have to look for. In terms of what you might look at ahead of a potential recovery, I'd probably stick with the producers, perhaps the companies that really dominate the full supply chain, so not just extraction, but also the downstream processing of lithium, which is really important because we think about China, which dominates the downstream processing of lithium. It doesn't dominate mining, but it does dominate the supply of the final product for EV producers. So looking at the select few companies globally which have this fully integrated supply chain from extraction to processing.
Yeah, and I think also maybe focusing on low-cost producers. I think the lowest cost producers is also maybe a safer option there. I think I mentioned that Citi report that sort of assessed lithium producers on a cost curve, and on current spot pricing, Citi analysts said that IGO is probably the only stock in its lithium company universe that's actually able to generate free cash flow at current prices. So that's something to keep in mind. And I think what was interesting for me, sort of when I was reading all of your recent research, was the emphasis you placed on interest rates. Obviously, some investors may think, oh, I'm invested in commodities. I mean, I'm focusing on, the ore in the ground. Why do I need to care about what the Fed is doing or the Reserve Bank? But you made a good point why it matters. And I think you sort of wrote that in a high-cost environment, traditional energies reign because they're much cheaper and there's better scale. And you call that obviously brown commodities. And when things are more expensive and interest rates are high, cost of capital is higher, those cost-intensive renewable projects are much harder to get off the ground, and maybe interest in them wanes. And obviously interest in those stocks falls as well. But I think we're sort of a bit of gloom and doom at the moment, but there has been one material that has done really well in the past few months, and that's sort of also associated with the green future. And I'm obviously talking about uranium, so I want to get your thoughts on that. I think this week uranium is now sitting at a 16-year high. I think uranium futures topped US 100 a pound this week. I think, for context, in 2007, the price of uranium peaked at an all-time high of about US 150 a pound. So we're approaching those areas now. And I think the AFR reported yesterday that all top five performing stocks on the All Odds so far this year have all been uranium stocks. That just goes to show the performance there. So I've got a few questions on uranium for you, but maybe we'll start with a controversial one. So do you see uranium prices reaching all-time highs in 2024? Why and why not?
Yeah, sure. So absolutely. So it's certainly possible. There's, I guess, definitely a sense of euphoria hitting the market. Is it for the trend followers, for the traders? I think that could certainly push uranium in past its all-time highs. It's already breached its pre-Fukushima peak from 2011. So of course, there's the next major leg up to break into all-time new highs. And given the sentiment at the moment, I think it's definitely possible. So I don't know if as a long-term investor, if that's really a sensible approach. It's perhaps more just for the short-term trader that would be looking at uranium as a potential trade in this market.
Yeah, so you see it more of a trade rather than a long-term investment. And so in your view, is the current rally unsustainable? Are you maybe expecting a normalization in 2024 and 2025?
I just think there's a number of factors which make uranium. Now, I do like the story. So nuclear, I think, is a great story. I think because it's a baseload form of renewable energy, it's become a lot more accepted against the high cost of capital, high interest rate environment that we've had in 2023. So it's becoming more mainstream, more accepted. I think it will be a really important part of the energy mix in the future. In terms of uranium and where it sits in meeting that sort of future, as a commodity, uranium is not actually that rare in the Earth's crust. There are a number of major deposits that we do know about. There's some big deposits in Western Australia, for example. But these haven't been mined yet based on state laws which prevent uranium mining in Western Australia. But if we see price pressure, so the incentive is certainly getting there for states to sort of back down on their policies. So that could potentially open up a lot of a supply for uranium deposits that we know sit in the ground. There's also several other factors which could also bring more supply online in the years ahead, which I think we'll touch on further on.
Well, I think I was going to ask. Obviously, I think part of the reason why uranium prices have surged in recent months was because the world's largest uranium miner, Kazatomprom, I hope I pronounced that correctly. It's the biggest uranium miner in Kazakhstan. It's sort of warned that it's likely to fall short of its production targets over the next 2 years, and I think it produces about 25 to 27% of the global uranium output. So clearly, if it says that its production is going to be curbed, that's going to have a material effect on supply. And if demand either stays the same or shifts higher from here, obviously that's probably going to put pressure on prices. But the question obviously is how sustainable that is. what happens if the Gazatomprom's obvious production, what if it was too pessimistic, and then it obviously says, we actually can produce the right amount. And obviously the question I have for you is, how elastic is the supply of uranium? So with prices now rising, I think maybe some marginal producers right now can be like, oh, hey, we can maybe now come online, or other producers can be like, okay, we can expand our production now. So how sustainable is this current high price, and will it maybe incentivize more supply and therefore put the price in balance again?
Yeah, so I guess over the shorter term, that certainly could put some pressure with this mine. I won't try to pronounce it. Good on you for pronouncing that company's name. But I think that could bring on some short-term supply issues because, say, these deposits that we talked about in Western Australia, which could be tapped into, that's looking at at least a 10 or 15 years of actually putting those into production. But what the big decade-long bear market in uranium stocks did for the market was put a lot of producers onto care and maintenance. So around the world, we've got uranium miners that are sitting on a lot of infrastructure. So that's in Namibia, there's Honeymoon in South Australia, there's some in Malawi, in Canada. And so we've got a lot of mining companies that have sat on care and maintenance for around a decade following the Fukushima price decline. So that means the infrastructure in place, we've got all the drilling, all the resource known. So putting those projects back online won't really take too much time, maybe 1 to 2 years to put some of these big deposits back into the feedstock, the global feedstock. So that's probably dampening the longer term outlook for uranium prices. It is unique in that sense because it has gone through such a terrible bear market that you've got a large supply of companies which could potentially come online with more supply.
Yeah. And I think also, and I'm now sort of picking up this sentiment that people that were once interested in speculative lithium stocks are sort of dumping that and now becoming more interested in uranium. So do you think there's maybe a risk of uranium sort of emulating lithium's boom and bust cycle that we've just seen playing out in recent years? Is there a danger for investors?
Yeah, absolutely. I think.
Yep.
Yeah, absolutely. I think there's a good comparison you can draw from there. So whether uranium is at where lithium was back in November 2022, I don't know. I think the story is still really good, especially for nuclear. Saying that too, I think the lithium story is good long term as well. I just think you're right that the market, the sentiment is really driving prices at the moment. But in terms of supply, uranium is just doesn't hold some of the sort of scarcity factors that you see for certain other commodities, and that's because it is relatively abundant. You do have these old mines which could come online, and you do have known deposits in states in Australia, which could really boost supply. And Australia is a major. It holds about 28% of the global resource for uranium, so it can really have a material impact on future supplies. So I think if prices stay elevated, I think that will really drive more stock onto the market. And I don't know if we've got time. I'll just sort of relay a story from my time back with Equinox as well.
Always have time for a story.
Okay. So back in 2010, what we used to do, so I worked for Equinox and we had a big copper mine in Zambia. And a problem with that mine was that there was a lot of uranium mineralization which would actually contaminate the copper. And what we used to do was stockpile this uranium virtually next to the waste dump, just sat there for potentially high prices in the future. And uranium mineralization is actually quite common in base metal mines. So it wasn't just Equinox; it's a lot of mines around the world that have this stockpiled ore, which could potentially be added into the future feedstock. So it is not really a rare commodity, and that's why I would be a little bit cautious where the market sits right now. If we see a sharp pullback, I'd certainly be interested in uranium, just based on the long-term story and where the importance of nuclear in our global energy needs.
Yeah. Well, wow, that's a nice story, because I think it's what's not priced in. Watch out for those stockpiles sitting around that might come online. That's great. But I think I've talked a lot, and I think maybe you're tired of hearing me talking. So I've got maybe one final question for you. You've mentioned scarcity factors. I think you've spoken about scarcity and how important it is in commodity investing. So I want to get your final thoughts on what your maybe favorite commodity or commodities that you're looking at in 2024 in terms of the scarcity factors, because you mentioned that obviously uranium isn't exactly scarce. Neither, for example, is lithium. They're both quite abundant. So in terms of the scarcity factors, what is your sort of favorite commodity?
Yeah, I mean, we can always look at precious metals, so they're always going to be scarce, so gold and silver. And I think, especially when we talk about where gold sits now, it's in a very technically strong position, just below its all-time highs. So that could bode really well for 2024. But in terms of the more mainstream common metals, base metals, so I still hang on to the copper. It's still very, it has a great story in terms of lack of supply coming out of Chile, with Codelco, just the largest copper miner, state-owned copper miner, just announced more supply cuts from its operations in Chile, and it is a major supplier for copper. We also saw the closure of the copper mine in Panama, which provides around 1% of the global supply. So it's why we've seen the accepted analyst consensus that copper is going to go into deficit in 2024. Previously, it was projected to be in surplus. So in terms of scarcity, I don't think you can go past copper or precious metals. And I think that holds the long-term theme of where you should be parking your sort of investments in commodities is those types of metals where we don't have known supply coming through. And if we add the demand factors in, that really just adds another element.
Yeah, great. Well, I think with that we will wrap up. But speaking of copper, you've obviously released quite a lot of very interesting research. So if anyone is interested in reading that more, you can check out James Cooper's writing, maybe at Fattel Daily, also at Livewire Markets, and obviously his service at Diggers and Drillers. But James, it was a really nice chat. We've had some technical difficulties getting you online today, but it was well worth the wait. And hopefully we'll have you on the show plenty more times in the future.
Look forward to it. Thanks very much, Kiryll.
Awesome. See you later.
Again soon.